One of the most overlooked aspects of retirement planning is tax planning. Even after you retire, taxes can play a major role in your financial life. Fortunately, there are several types of income that are considered non-taxable by the IRS. In this video, we're going to discuss some of the common types of non-taxable income that you may receive during retirement. But before we cover those items, welcome to the Money Briefing. My name is Jarrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. Once you retire, taxes will not go away, but you could potentially reduce your tax liability based on the types of investments, assets, and accounts that you utilize to generate your retirement income. For our discussion, we'll primarily focus on income that is not taxed at a federal level because each state has different rules on how they tax various forms of income. So let's start our list with the most common way to avoid taxes on your retirement income, and that's by using a Roth account. Federal employees can use the Roth TSP, and if your income falls under certain limitations, you can also use the Roth IRA to build up funds that can be withdrawn tax-free during retirement. Roth contributions are always tax-free and penalty-free at withdrawal, since they are made with money that has already been taxed. You can also withdraw any earnings tax-free and penalty-free once you reach the age of 59 and a half and the account is 5 years old. Another advantage of Roth accounts is that you're not obligated to take required minimum distributions, which allows your money to keep growing tax-free through retirement. Beneficiaries can also make tax-free withdrawals from an inherited Roth account as long as the account meets the 5-year rule. A second way to get tax-free income during retirement is through life insurance. The primary purpose of life insurance is to provide protection for loved ones upon a person's death. But because of the tax advantages of life insurance, it can potentially provide supplemental income during retirement. There are two categories of life insurance. One is term insurance and the other is permanent insurance. The death benefit of both term insurance and permanent insurance is paid out tax-free to beneficiaries. But permanent insurance, such as whole life and universal life, also provide two other tax advantages. When you pay the premiums on a permanent life insurance policy, a portion of your premium goes toward insurance costs, and the remaining balance of the premium goes into a cash value account. The cash value grows tax deferred like most retirement accounts. You can take either withdrawals or loans from your cash value. Withdrawals are generally tax-free as long as you don't withdraw more than what you've paid in premiums. If you take a loan from the cash value, you can borrow against both the premiums that you have paid as well as the gains that you have earned tax-free. The drawback to a cash value loan is that the insurance company will charge you interest. You are not required to pay the loan back. However, you should keep in mind that tapping into your policy's cash value may reduce the available death benefit. In addition, if the policy loan plus the cumulative loan interest ever exceeds the remaining cash value, the policy may lapse or require additional premiums to be paid. Another source of tax-free income is through municipal bonds, which are also known as muni bonds or munis for short. Municipal bonds are issued by states, cities, and other localities, and they are typically used to fund public projects like schools, parks, and highways. Most muni bonds pay interest twice a year. The interest that they pay is generally exempt from federal taxes, and when you buy muni bonds issued by your home state, you can avoid state and local taxes as well. Muni bonds can be a reliable source of income during retirement due to their tax-exempt status and conservative nature. You can buy individual muni bonds, or you can get a portfolio of muni bonds through a mutual fund or ETF. It's important to note that the tax benefits of muni bonds apply to interest payments only, not capital gains. So if you sell a bond for a profit, those gains are still taxable. A fourth source of tax-free income can come through your primary residence. During retirement, many people decide to sell their primary home and move to a new location. Studies have shown that some of the biggest reasons that people choose to move are taxes, to downsize in space, to get closer to family, or to enjoy warmer weather. If you are single, you will pay no capital gains tax on the first $250,000 of profit from the sale of your home. And married couples who file jointly can get a tax exemption up to $500,000. To qualify for this tax benefit, your home must be your principal residence for at least 2 out of the last 5 years. A fifth source of tax-free income during retirement can come through an HSA, which stands for a health savings account. These accounts are one of the most tax-friendly vehicles because contributions to an HSA earn a tax deduction and your earnings within the account grow tax-free. When you use the funds to pay for qualifying healthcare expenses, the withdrawals are also tax-exempt. Since healthcare costs tend to increase with age, HSAs can be a great resource for retirees. The best use of HSA will always be for healthcare expenses because you can withdraw your funds tax-free at any time. On the other hand, HSA withdrawals for non-medical expenses are taxable as regular income. Also, if you use the funds for non-medical reasons under the age of 65, you may incur an additional 20% penalty. As I stated in the beginning of this video, you may not be able to totally avoid taxes during retirement, but some of the income sources that we just explained could help to reduce your potential tax liability. As you review your various investments and accounts, you should also be mindful of the different rules and stipulations that must be met for the income to have a non-taxable status. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, please visit our website at www.fedwayfinancial.com. Thank you for watching, and we'll see you on the next Money Briefing.